The next slide shows a move from A up here to 0, back to 0.1, and up to what we call the focus number. You can get two Fibonacci ratios between A and F, and you can get two Fibonacci ratios between 1 and F. When you get a 0.382 and 0.618 ratio in close proximity, this is called a confluence level. Now, admittedly, this is way too fast for you to absorb if this is the first time you were exposed to it. But this is it gives you incredible ways to find resistance and support levels out in front of the market. It's a leading indicator. So this, in this case, would be a high level of support. Now, let's go and take a look at an example of this. This is an example of the oil. By the way, I spoke at the China markets. What was that called, Jason? The China, what's that forum we did in 2008? China Capital Markets Forum. And bunch of, government dignitaries were there. Goldman was there. Merrill was there. All the big wigs were there. And I was the only technical trader. At that time, I called a high to oil because we had Dinapoli level resistance at approximately 135. Everybody was quite surprised. At any rate, after that high, we came down and noticed this confluence area. That confluence area was the buy area for this market to then go up and do what we call a wash and rinse of the top. That's how we hit the 143, 144 area and then fall. The point I want you to recognize is that the confluence area developed from focus, reaction, reaction, provided those two numbers. And those two numbers provided substantial support for the market. Again, if you want to learn this material, there's a book that I've written, the only book I've done, that will show you how to find these areas. Now, if you have 3 reaction lows, you can get 6 fib nodes. You can get two fib nodes, 0.382 and 0.618 between 3 and 1. You can get 2 more between 2 and the focus number, and you can get 2 more between 1 and the focus number. In this case, you have 2 confluence areas. Now, the thing you want to understand about confluence areas in an up move is that they provide tremendously strong support to a market. That's what you want to be aware of. The next thing you want to be aware of is that you can calculate these confluence areas, Dinapoli levels, before market action. So if we look at the E-mini after we had this last move up, if you look at the E-mini when it was at its highs, you can actually plot these points well in advance. This is a daily chart, I believe. Daily. Is it a daily? Daily. Okay, it's a daily chart. And we have a confluence area right down here. See that? Right there. I put in about $500,000 worth of buy orders right down in this area for various stocks which had a similar appearance when I was traveling here to Las Vegas. I only got filled on about $200,000 worth. And that was down here. We noticed the market came right down to the area of confluence. See that? And when it hit the area of confluence, it shot up. The point I'm trying to make clear to you is that if you know how to calculate these levels, you can, with pretty good accuracy, not always, in case there's regulators listening, not always, and you can lose money with this, obviously, you lose money with anything, but very often, as is shown here, you can pre-calculate areas that have substantial support to them. Now, one more thing I want to talk about is this concept of agreement. If the market goes up, between this high and this low, we can have 2 areas of Fibonacci, 0.382 and 0.618. But if you have a down move, A, B, C, OP move down, and the OP move down or the COP move down comes in conjunction or close to the 0.382, you get an area of agreement. This is even stronger than confluence. In this particular move, if we do not exceed the high that's shown on this chart, and we may have today because I didn't look at the markets, if we do not exceed that high, we will have an A, B, C, COP down move just under that low, still within the area of confluence. See how that works? A, B, C, COP, OP, XOP. That COP will come in under those lows. Under those lows is where the public's going to put their stops. Under those lows is where I'm going to be buying, assuming we don't make a higher high. If we make a higher high, I have to change the C point. When I change the C point, that will change the location of the COP, OP, and XOP. Now, I've given you this rundown so that you can hopefully understand what I'm coming to. So keep that stuff in your mind. Right now, I want to talk about strong structures. Remember the Krakow salt mines and how strong they were. Well, when you get a market like we had in 2008, early 2009, you know, it's falling, has the trajectory of an anvil. Okay? When it's falling hard, here is an example of a strong, substantial market bottom. We come up, we make a low, we make a high, we make a lower low, and then we take off. Now that is a nice, strong market structure. This market is a strong market. What's happening here is that you are coming up off the bottom, you're coming to a 0.618 retracement of that down move. You're then making a 0.382 retracement of that up move. You're then making an A, B, C, COP, where you will find resistance because you have COP resistance. COP resistance will then push the market down to a 0.618 of the entire up move. Right there. All right, from that point, the market can take off. This is very strong, very stable market action. And these are bottoms that we as professional traders look for. Here's another example. In this example, the market is coming up to a 0.618 retracement of that down move, coming right up here, having a 0.618 retracement of that up move, making an A, B, C, OP move up, then coming down and doing a double bottom. Or for those of you that know my material, you would probably see that as a double repenetration signal. Now, in markets like this, liquidity providers are being rewarded. This is a really, really important point I want you to understand. Let's say you got a 120-minute chart. All right. Within this 120-minute chart, it comes to a point of resistance. Inside here, if you drop the time frame, your half-hour traders, you have an ABC, OP move up into that high. Your half-hour traders are providing liquidity for your 120-minute traders. Your 120-minute traders are providing liquidity for your daily traders. Your 5-minute traders are providing liquidity for your 20-minute traders. And in this case, the liquidity providers are being rewarded. When you make this pullback down here, those people who were selling out in the market are then rewarded because they are able to repurchase and buy back in here at this bottom. Now you can move up, and internally to this up move, you will have ABC structure where ABC, OP, liquidity providers will then provide enough liquidity so that this market will turn and you will create a market structure so that those people left behind will have an opportunity to get in. Those people that have gotten short will have an opportunity to get out. Okay, hear that last statement. Those people that have gotten short will have an opportunity to get out. I don't know how many of you are old enough to remember the old advertisement. It went something like, "Don't piss off Mother Nature." Remember that one? And with thunder and lightning going off? I don't think they used the word piss off. But let's imagine you've got a big trader, and he got short the market, and he didn't have any chance to close those shorts at a break even or at a profit. You know what he's going to do? He's going to stomp on it. And he's going to stomp on it when it is most likely that the market is weak, and or when the market gives a technical sell signal, and or when some minor news comes out. And this creates tremendous volatility. Now, when you have markets like this, this creates a tremendously unstable structure because the liquidity providers on lower time frames have no ability to take profit or even to get even. They keep getting hurt. Now, when liquidity providers get hurt, they either go away because they lost all their money, or they get angry and stomp on the market and try and push it down and give you excess volatility, or they simply don't trade anymore. And when they don't trade anymore, what do you get? Illiquidity. Everything I'm talking about here is creating the illiquidity, which I told you is responsible for the 1987 crash and is responsible for the flash crash, as well as the mini flash crashes we have had. Take a look at the move from September to November. Now that you understand something about market structure, you can see that as an inherently unstable move. Now let's take a look at what happens internally when you create these Dinapoli confluence levels. It is unbelievably rare in any kind of a normal market. See that consolidation right there? Right there, that consolidation. That happened because people were selling against that confluence area, but they were not rewarded. The market went sailing up here, even went through the agreement area created from the ABC, COP, and 0.618. It even went through there, and then somebody stomped on it hard to bring it back down, and immediately it flew back up again. This isn't stable. This isn't stable market action. Now, here's the flash crash. Now, why do you suppose the flash crash happened to stop at that exact point? I'll tell you in a minute. March through August 2009, another example of an unstable market. When you've got a market crashing down from a disastrous financial situation, a V bottom, or what we would call in the book Trading with Dinapoli levels, we call that a railroad track. This sort of thing doesn't often happen, much less happen regularly. Now, when we announced Counterfeiting 2 about a week ago, we had a move. This move went A, B, C, COP, OP. See this OP at 119,925? That sucker was totally ignored. We blew through there like it wasn't even there. We went up here to the XOP and consolidated. This is not normal market action. And when I saw this, I said to myself, oh boy, we are going to have somebody stomping on this market and getting it back down to this 1199 area. Where did the last break bring us to? Right about the 1199 area. Somebody was the wrong way. Now, here's another example of how the market is jamming through these levels. This is not healthy, and no one at the Fed is understanding this. Additional causes of illiquidity: less players because of the financial crisis, sub-penny pricing. I showed you what that does. Quote stuffing. You know, it's not enough that they screw you with sub-penny pricing, but now they're doing quote stuffing, which is a form of denial of service. What they're basically doing is stuffing up the computers with a bunch of orders that don't belong there, prohibiting anybody from accessing those computers until they make their $1 million. And what are the regulators doing? Silicon form life forms trading. All right, basically what that is this program trading where you have computers shooting orders in. Now, normally, if the market is liquid, that's not an issue.